Trident Royalties is a mining royalty company. It's listed on AIM and on the OTC market in the US. There's been many investor updates this year, including director share purchases, including those made by the chief executive, Adam Davidson. So, Adam, the quarterly report, will start with that. It was in many respects a metaphor for the mining industry. For example, the update mentions seasonally lower deliveries from the gold offtake portfolio. So what is that a symptom of? The weather or the capabilities of the off-takers?
No, a combination of things. We do have a couple of projects in the portfolio that are impacted by weather. But by and large, it's the fact that most producers try to cram out every single ounce they can in Q4 of the preceding year to try to get up their annual numbers, but you're kind of robbing from Peter to pay Paul. So what you typically see is then a step down in production in Q1, and then it kind of rises back up in Q2, and then you have a strong Q4. So there's a bit of this cyclicality to it, which is all expected, but we do like to flag it to the market because not everybody's into the weeds to that degree.
A lot of investors are into copper as well as gold, though, and I can see that you've got a 0.3% gross revenue royalty over Mimbula, or at least you have over the copper that's produced by that mine. But I'm just wondering, is it worth it at that level, 0.3%? Copper, precious commodity, shouldn't that percentage be hiked?
Yeah, for us, it's less the actual absolute percentage and more the cash flow. So on this particular royalty, we had a 1.25%. And we had that coupled with a minimum quarterly payment schedule. And those both persisted until we recovered our deployed capital, which happened in the middle of last year. So basically from 3 years from deploying the capital, we had all of our money back and we'd now been into profit for sort of a few quarters. But with that, the royalty stepped down to 0.3. That said, the mine is targeting ramping up to 56,000 tons a year of copper by middle of next year. Current copper prices, that means the royalty would be paying roughly $1.7 million a year on a $5 million investment that we've already recovered our $5 million and then some back from it. So, yeah, would of course like it to be a higher percentage, but very happy with the way that one has played out.
So you're talking about spot prices there. Remind investors about the quality of the portfolio. Are you asset particular or resource or agnostic? Or are you strongly attracted to those strongly performing spot prices?
Yeah, I mean, really for us, the objective is to be so broadly diversified that you're getting exposure to the entire sector. So, yeah, maybe one commodity's in the doldrums while another one is at all-time highs. And you get this offsetting sort of effect, which means that we should inherently be less volatile with regards to share price and cash flow. I think what we naturally find is that commodities where the spot price is suppressed, that's usually where we find the best opportunities in terms of deploying capital. So it's almost not even a conscious decision because it pops out when you're doing the analysis that if prices are low, it's just more return to be had effectively. So it probably impacts the way we look at new deals, but not quite so much the portfolio. We're on this journey of building out a diversified portfolio. If you recall, when we listed, we had one single iron ore royalty. So effectively, Trident was 100% iron ore exposure, at least for the first month of its existence. But you fast forward to today, there's lithium, copper, gold, silver, iron ore, lead, zinc, mineral sand. So a good spread of commodities, but actively looking to continue to widen that out.
Okay, so this is an opportunity for you to bask in the recent news that you shared with investors, the offtake milestone for Paradox with battery giant LG. Now, you own a 2.5% net smelter return royalty over Anson Resources projects in the Paradox Basin. So was this an example of serendipity for you, or do you actively search for offtake-ready opportunities?
We're actively looking for projects that we expect to have catalysts that add value to the royalty. So something like Paradox, and you've seen it in other assets in our portfolio, But you want to see, now they've got an offtake with sort of a tier one counterparty who's contemplating a direct investment into the company or the project. It's those sorts of things that you do want to look for. So it's not that we're necessarily particularly wedded to offtakes in particular or wanting to make sure that the operators have them in the near term. But it's these sort of catalysts, whether it's getting an offtake with a tier one or the scope for the project to expand. If you remember, shortly after we bought the Paradox royalty, the very next month they increased the resource of the project by 40%. So it's those catalysts that we don't have to pay any more for that royalty. We own it, but the royalty becomes more valuable as these events occur. So it's definitely something that we keep an eye on, and we have certain expectations internally when we're making our investment decisions. So glad to see them starting to play out for some of the assets that probably don't get much of the spotlight within our portfolio.
So in terms of investment decisions and catalyst-rich opportunities, what shape is the active deal sourcing in? Because according to your update, you're looking to acquire from closed-end funds, prospect generators, junior and mid-tier miners holding royalties and counterparties. That's quite a wish list. So what does it look like at the moment?
Yes, I mean, it's pretty full of pipeline, as you can imagine. We've had a few sort of recently slip through our fingers, but we just have to remain disciplined. The way you can destroy value is by going out there and overpaying for assets. So we remain disciplined. We're going to continue to build out the portfolio. Here we did 5 acquisitions last year, 4 that were material. We've done 1 small acquisition this year that we announced in the quarterly. So I think there's no shortage of opportunities. That list of potential counterparties you flagged, I mean, that's pretty wide open hunting ground for us. And we've done deals with counterparties, I think, across that entire list effectively at this point in time. So no shortage of deals to review. I think we're pretty comfortable. Having announced the completion of the debt facility in Q1, we've now got very good access to capital with that low-cost revolver. And yeah, as I've said before, this is the way that royalty companies in the gold space have really grown, is once you can get a revolver like that in place with the big commercial banks, which we've now done, you can draw on it, make acquisitions, pay it back, draw on it, pay it back, repeat that process. You've got a much lower cost of capital than nearly all the miners out there, except for the majors. So we're in a really good position to continue to add to the portfolio.
Because I was going to ask you, is debt the preferred option for financing as opposed to equity and capital fundraisers?
Yeah, absolutely. I mean, obviously with the caveat that we need to be sensible and you don't want to get over-levered, but I think we're conscious of that. And that's really how you grow share price, most importantly, is you're making acquisitions, but you're using your lowest form cost of capital, which for us is the debt. So as long as you keep the debt maintenance at manageable levels, then to be able to use debt to build the portfolio and to preserve your share capital, most importantly, that's really the name of the game. And so that's sort of our sole focus. We want to add to the portfolio. We don't want to agonize over these things so much that you sort of stagnate, but it's a very critical piece of the equation when we're looking at a potential transaction.
So do you agonize about those deals that have slipped through your fingers? Why have they not materialized? Is it because there's now more competitors copying what you do?
A little bit of that, not so much. It's, I'd say in most cases, it's that you can't meet on value. You table a number, the counterparty says that's not enough, and we park discussions, because by and large, most of the deals we've done, in fact, the vast majority have been bilateral, where we're not sort of competing directly with peers. We found that to be a waste of time in many cases. There's some we've been able to find some value there, but in most cases, if it gets into a competitive dynamic, then you're paying up and you're not able to meet our internal return hurdles, and it's just not a smart way to build the business. So no, usually it's because the counterparty just can't get their own value. What we've tabled's not attractive to them. But with the caveat of, it's not uncommon for these things to circle back around. I think when I think back on all the deals we've done at Trident, the one that took the longest was probably close to a year and a half from sort of when we first tabled value to when we finally completed the deal, because at one point in time they threw up their hand and said, "Now we can't get their own value." 6 months later, they come back, have another conversation, and then they go away again, and then finally you ultimately get there. So yeah, these things never really go away completely. Typically, you can stay in the conversation, And you just have to be patient and disciplined and make sure that you don't sort of chase deals just to get the headlines out there. You're doing deals for value.
Okay, a couple more questions to do with the headlines, if I may, Adam. And, looking ahead to the next quarterly report, do you anticipate any seasonal variables on the revenue stream?
I suppose the way seasonality would play into the offtakes is that we usually step up. Q1 is the lowest sort of volume of delivery of ounces for the offtakes, for the reason I mentioned. Everybody's sort of pumping out as many ounces as they can before December 31st, and then you kind of typically have a quiet January, and then it sort of steadily ramps back to normal. Yeah, I think we flagged in the quarterly that we're already over $1 million on the offtakes through where we stand today. So moving pretty briskly, as you can imagine. Gold's performing well, and it's very volatile, which both are positive for the offtakes. But then other assets as well. I think it's Greenstone expecting to have first gold this month. It's Preciosa flagging that they've commenced stockpile production at that silver project and are targeting fresh ore before the end of the year. So I think a lot of focus is on assets like Thacker Pass. Obviously, that's our biggest asset on a NAV basis, and it's had some great news this past quarter in terms of the DOE loan for $2.3 billion and then the $275 million equity raise. So it's now fully funded and into construction. But it's assets like Paradox, Greenstone, Preciosa. These are all adding value as they advance towards cash flow in some cases, or develop the project and expand the potential for cash flow. So yeah, I think Q2 is stacking up to be pretty attractive for us, and hopefully a couple of transactions that we're looking at could potentially come to fruition as well.
Let's put all the past quarters together, because recently you released your annual figures. What were the headlines? What were you most proud of, and what could you do better?
Yeah, I think the accounts for a royalty company are really hard for people to pick apart. Because we're amortizing the cost of the royalties against revenue. Some royalties are fair value adjusted, so it's a bit of a Gordian knot to try to figure out what you're looking at. But I think the numbers at a high level is sort of $11 million in collective revenue on the royalties. So that was very positive. We expect to see that again step up this year. In terms of cost, about $5 million. Again, some of that is sort of amortization and whatnot. So we look at our steady state as about $4 million. It really depends how busy we are, though, because a lot of that is going to sort of lawyers and tax advisors and technical consultants as we're making acquisitions. Last year was a very busy year. So when those costs are high, it's usually because we're very busy. So not necessarily a bad thing. And then debt service, we flagged if that debt facility is fully drawn, it's $2.5 million in annual debt service. Now it's a little over half drawn today, so obviously half of that. So, we're cash flow positive if you sort of step away from kind of the accounting treatment, $11 million in revenue, and then those cost aspects I flagged. We're cash flow positive, and so what that means for us is every incremental dollar, as assets like Greenstone and Preciosa turn on this year, every incremental dollar of revenue that we generate should flow to bottom line, straight to profit. And then, a few years out, as we see assets like Thacker Pass and Paradox moving into production, those become very meaningful numbers. And that's where you can see sort of line of sight of a dividend. We want to continue to add to the portfolio, recycle capital as we stand. But yeah, that's the trajectory of the business. So very, very happy with the results last year. Expect them to be better this year.
I can't leave it like that. The line of sight to a dividend, what's the timelines there?
Yeah, a question I get all the time. I think without being too opaque, it is seeing some of those assets sort of into cash flow effectively. An asset like Thacker Pass, we've only touched on it briefly, but it's slated for first production in 2027 and then full production in 2028. And it's now very de-risked in the sense that it's fully funded and it's entering construction. It entered construction last year, but now it's really meaningfully getting into the core of sort of construction. So it's being de-risked materially over the last sort of 12 months, but we wanted to get a little closer to cash flow before you want to start having cash flow out in the form of a dividend, because there's no worse mistake you can make than to start a dividend and then have to frantically stop it. So we want to be sensible in how we approach things. And it's not all linked to Thacker Pass. There are other assets in the portfolio that we want to see happen, expansion of those filos. Paradox, get better line of sight to production there. Similar with Antler Copper, see Mimbula ramp up, see Preciosa ramp up. So, yeah, I think as we see this, and they're all moving in the right direction, that's when you'd sort of see it would make sense to turn on that dividend. And when you do that, you want it to be meaningful. You don't want to sort of have a token dividend. So it's trying to align that in the right way. The final thing I'll flag is that this is the portfolio we built in, 3.5 years that we've been listed. And so over the next few years before Thacker turns on, we're going to add other assets to the portfolio. So the objective fully is to try to pull forward the date that we can commence that dividend, because we all recognize that will be a very good day for the share price and for our shareholders. So very focused on it, but want to be smart in how we approach it.
Many thanks. Adam Davidson, Chief Executive of Trident Royalties, thanks for your time.